Have you ever thought that you could predict a turning point in the market? Obviously, if we're able to buy at a low price before price turns bullish and everybody else buys, we have a significant advantage in the market and an edge when looking to get out of our position where everyone else is scrambling to get in. This is the nature of trading reversals, and there is no more popular identifier of a reversal than divergence. So in this video, we're going to talk about the 4 main types of divergence: regular and hidden divergence. Although in this video, we're going to focus mostly on regular bullish divergence. We're going to talk about what it is. We're going to talk about how to trade it. We're going to talk about its benefits, and we're going to talk about its drawbacks and limitations, and ultimately why it doesn't make it into my trading strategy. But we're going to break it all down in today's exciting episode of Trading Crypto 101, Trading Divergence. So we're going to talk about divergence. The way that divergence works is there are 4 types of divergence. There is bullish divergence, there is bearish divergence, there is hidden bullish divergence, and there is hidden bearish divergence. So a bullish divergence is what's going to happen when price is moving down. And what happens is price makes a lower low than a previous low, yet your oscillator makes a higher low than the oscillator's previous low. Conversely, hidden bullish divergence is going to happen in an uptrend. And that is going to indicate that you should be buying back into an uptrend, whereas regular bullish divergence is going to be happening in a downtrend and be an early indication, quote unquote, of trend reversal. Conversely, regular bearish divergence is going to happen in an uptrend, and it is when price makes a higher high than normal, yet your oscillator makes a lower high than normal. And that can often indicate weakness. That what that is purported to show is weakness in the uptrend strength. Especially the most popular indicator that's going to be used for divergent purposes is going to be the RSI. That's your bread and butter. Everybody tries to use that. Now, I don't think it works very well. I have traded with something that I think is far superior to the RSI. As you guys know, my feelings about the RSI, I think it's a pretty terrible indicator. But an indicator that actually is quite good is the Fisher transform, depending on how you use it. I traded reversal patterns with the Fisher transform for a very long time. Time transformation, which is one of my proprietary indicators, is based off of my interpretation of John Eller's Fisher transform algorithm and its applications in the cryptocurrency market. It is an indicator designed 100% to trade cryptocurrency. So regular bullish divergence, when properly identified, can help you. Again, keep in mind that what I'm about to say really has nothing to do with the way that I trade. This is just general trading education, right? So the way that regular bullish divergence is helpful is when identified appropriately, the oscillator does do what it is intended to do. Alberto, thank you so much for joining over there on YouTube, my good friend. When identified correctly, this indication or this pattern is exactly what happens when a market is going to have a reversal, right? You are going to have sometimes your indicator put in a higher low and price put in a lower low. That is a sign that is intending to show you that the volume or the momentum to the downside, because we have to remember that almost all oscillators are measuring momentum. Momentum is the strength of the movements of the candles, right? As opposed to volume, which only has to deal with units bought or sold within a certain window of time. Or if you're talking about something like VPVR horizontally. So when correctly identified, it can help predict turning points in the market insofar as any market prediction is possible. That is the point of bullish divergence. The problem with bullish divergence is that you have to wait for bullish divergence to be confirmed. And what you have to wait for is you have to wait for price to actually close and start moving up. Because when that happens, your indicator will then bottom up, right? So let me show you guys an example. We'll use the bar replay feature to kind of show this live example. So we're just going to look at ARC right here, and we're going to be looking at the Fisher transform, which is what I have down here. So as we can see here, let's look at this example. So here on this time frame, we can actually see the Fisher transform make a bottom on the 18th of July. Let's go find that chart right there, and that would have been a pretty decent buy. The problem is you need 2 candles to confirm a U bottom, right? Because as you can see, let's do the bar replay feature, and let's go to the close of the 18th. So you had no idea when that candle closed. So when the candle closed, this is what the Fisher transform would have looked like. So prior to the candle close, it would look like this, and directly after the candle close, it would have looked like this. So the problem with this is that you have to wait for candles to close to have accurate indicator data. I can't tell you how many times I've seen price run up above the baseline intraday, not close above it, and any position that you might have taken in anticipation of the breakout or thinking that you were seeing a breakout ends up being a losing trade because you didn't wait for the candle to close. There's something very important about waiting for a candle to close. Primarily it's about having market data, because your indicators are going to be updating based on price action, based on price action activity. So if you need to wait until your candle has closed or is about to close to have the most accurate data. So the problem with there's another reason though that you want to wait for the candle to close, especially if you're looking for a momentum trade, because it's very easy for price to, especially in crypto, to run up very quickly and get sold right into. And then that was it. It was basically a micro pump and dump, right? Where you had a big buyer step in, pushed price up, or a lot of buyers, guppies, and then you had a large seller dump on them, and then that's it. Like nobody came back in and pushed price up. And how many times have we seen this? We see this all the time. It happens in every asset class, on every market, on every chart. You're just going to see price run up, look like it's going to break out. You take the trade, like in between the candle opening and closing, and then the candle ends up on an evening star pattern or reversal candlestick or gravestone doji, and price just moves to the downside and your long trade gets stopped out. It's happened to everybody. The other reason that you want to wait for a candle to close is because if a candle breaks up, right, and puts in good bullish momentum to the upside, and then can close relatively high, what that means is that buyers who came in are not only defending their position, most likely there are additional buyers that are also coming into the market and helping to continue to push price up. So when you see a candle go up and right back down, that's not a sign of strength. But when you see a candle go up, down a little bit, and then push back up and hold that level on a closing basis, that is a higher statistical edge that you're going to have. The price is going to continue to go up because it shows strength to the buyers. It shows strength to the buyers. So in the case of divergence, what we're trying to do with regular bullish divergence is attempt to predict a turning point in the market. So that's a benefit, right? Because that means that if you can buy lower, if you can identify when price is going to be bullish than anybody else, then you're going to have a buying advantage, right? You're going to have an edge. Because if you're buying lower than everybody else and price starts moving up, then you're going to have a profitable position and you're going to have the leisure to manage that position as you want. However, the downfalls of divergence is that so for you to not jump the gun, because as we can see here on the chart, we have no idea exactly what's going to happen. If we go ahead and start playing the bar forward a little bit, we'll press play, and we can see that. Let's actually go back. Let's just slow that down just a little bit and go back. Here. I think this is where we were. All right, so let's go see one more bar. Okay, so one more bar. We can see price continue to move down a little bit. That's the close of the second bar. And let's play a little bit more. All right, so the second bar, we can see price curve up. That's still not good enough. We need to see a convincing bottom, right? Which means you need two candles. And there's one more candle. Now, two things happen here that's very interesting. You've had two closes confirming the divergence. This is now a confirmed bottom. And you've also had, in this situation right here, you've had this indicator cross up above its signal line, right? So that is a much more powerful signal than predicting divergence. Now, the benefit of this is that you have market confirmation. Doesn't guarantee that your trade will be profitable, but you have a higher level of confirmation that the bottom is in on this particular oscillator, on this particular price movement, especially in this case, if we have divergence where price is making a lower low. Let's take a here. This doesn't really count. We do have a bottom here, so this isn't a good example of divergence, though. The one that's currently taking place is. But especially if price action is making a lower low, we could actually see here. Maybe this is a decent example. If we zoom into the indicator, we can see that this is the more convincing bottom. But I tend to use anything that has a down and then moves up two candles as the bottom. Otherwise, you get way too subjective with your divergence. So you have to just set a rule. And the rule for divergence that I always traded with is anytime the oscillator bottoms and then moves up two candles, that is a bottom. We're not going to just go back selectively and pick a bottom, right? Because if we just went back selectively and picked this bottom, That would be picking and choosing. And now you're in the realm of subjectivity. You're in the realm of price action. You're in the realm of wishes and fishes. And as a technical trader, that is absolutely not what I can have in my system and my strategy whatsoever. So let's get rid of that. So, okay. So basically, I guess the TLDR of what I'm trying to get across here is that the benefit of divergence, or the strength of divergence insofar as it applies to a strategy that can be built around divergence, is that it tries to accurately predict a turning point in the market before other buyers are going to step in and buy, right? Which allows you to try to buy like institutional money, right? Like smart money. The danger of divergence is that it works the best when you trade recklessly, right? So let me rephrase that. It works the best when it works. So when you do accurately identify when a local bottom is in, right? Whether you're using support and resistance or whatever you're trying to use. With the use of with the help of divergence, right? So you can see that price is making a lower low, and you see your divergence indicator also making a higher low as opposed to your previous low, and you predict this as a turning point in the market, and you buy, and then you're right, and price goes up. You're going to have a significant edge over other individuals that were buying into the market, because now you are going to be the individual that is trying to dump or get out of your position on a big green candle, whereas other people who haven't bought in yet are going to be attempting to buy in now. So you have a significant edge over them. The downfall is that happens less often than one would think, than one would be taught to think, right? And this is why I don't trade reversals. But as you can see from that previous example, there's no. If we look at where ARK BTC is right now, there's no bottom here. There's no bottom. Like anybody that's looking at the chart and saying, hey man, there's divergence. There's no divergence here. The reason why there's no divergence here is divergence doesn't happen until your oscillator forms a bottom. You can't just predict that this is where the oscillator is going to turn around. You have to have a candle close and actually turn your oscillator around. Now, I don't like jumping in. I don't like jumping the gun and buying on the first candle, because that basically means that any slight bullish candle at the bottom, any corrective candle in a downtrend, you're going to be trying to go long on. I like to see, if I were to trade a reversal and I was going to apply strategy and strategic thought to this, then I would want to see two. I would want to see two candle closes. Ideally, and a great example is closing above the signal line on your indicator if you have a hybrid indicator like the Fisher transform. But definitely confirming that divergent bottom. And then if there's divergence there, so much the stronger. So that is regular bullish divergence. The benefit is that it does allow you to buy at a cheaper price when you are right. The downfalls is that you do have to wait, and that reduces that lower buying edge, because now by the time that you have waited for two candles, you are now basically buying a breakout of a little bit of consolidation most likely, or you are buying momentum, and now you are buying on a green candle, potentially moving up. So those are the downfalls. And again, it doesn't have as high an accuracy rate as you would consider. And I think the reason for that is that most people, when they are testing this, are doing what I said we shouldn't do, which is predicting that the bottom is in on an oscillator. Until you actually see the bottom come in, then there's really nothing there. Now, this is helpful on higher time frames. So something like the weekly, for example. So if we go to the weekly, or something maybe like the 3-day, and we spot divergence on the weekly or higher time frames, this can often be helpful when looking to establish a positional trade. A positional trade, as opposed to a swing trade or a day trade, is something that you plan on holding for months or weeks, if not longer. Whereas a swing trade is something that you plan to hold for, 2 days, 3 days, 4 days, maybe a week at the most. And a day trade is going to be something that you look to get in and get out of on the same day.